This is the first of the two methods that I mentioned in the first video. So this is the standard method for dealing with adjusting entries. This is primarily what you're used to. So whenever we've dealt with prepaids or accruals in first semester and second semester, you've been accustomed to posting the initial entry right to the balance sheet. So for example, if we prepay for 12 months worth of rent, when we make that initial payment, we know that we can't just debit rent expense, credit cash, right? Because we haven't used up all 12 months of the rent that we've paid. So what we do is we set it up on our balance sheet as a prepaid expense, and then our adjusting entry reallocates some of the amount to the income statement. Typically this is done on a month-by-month basis as we use up the rent that we've paid. Right? So that's what you're used to. That initial entry goes to the balance sheet, and then therefore the adjustment goes to the income statement. That's the premise of this whole method, right? And it's what you're used to. So of the two, this is going to be the one that should really ring true to you and be something that you're used to. So let's look at a quick example and try and apply this methodology, right? So remember, the first entry, the initial entry when we prepay something or when something is prepaid to us, the full amount gets posted to the balance sheet and then we adjust to the income statement. So let's use the following example to demonstrate it. Carter is the staff accountant at Blondia Rocks Inc. He's been asked to record the payment of the insurance premiums for the year on January 1st, and they total 120 grand. So let's take a look at the entries to see, he has to make on January 1st and January 31st. So we're prepaying $120,000 for the entire year. That covers our full year's rent, right? So 12 months, $120,000 divided by 12 months means that we're only using up $10,000 per month in insurance expense. So under the standard method, the initial entry is always going to go to the balance sheet first, and then we will adjust to the income statement. So on January 1st, when we prepay the full year of insurance, we're going to debit prepaid insurance and we're going to credit cash. Okay? That's the initial entry. That records it, and you'll notice the full amount went to the balance sheet. But it covers a 12-month period. That's why we weren't able to just put it directly to the income statement, because it covers more than just 1 month, right? So what entry is Carter going to have to do on January 31st? Well, he's going to have to take a portion of this prepaid amount, and he's going to have to move it from prepaid insurance, and he's going to have to set it up as insurance expense. This could work for any type of prepaid amount. It could be prepaid rent, it could be prepaid insurance, it could be prepaid subscriptions. Whatever the prepaid is, we're going to set it up on the balance sheet and we're going to move some of it to the income statement. So at January 31st, Carter now has to do a journal entry to recognize the fact that 1 month of time has elapsed, and we need to post an adjusting entry to pull some of that prepaid onto the income statement. So again, if you look at the bottom here, I show you the calculation, but we had $120,000 in prepaid expenses. We've used 1 out of 12 months, right? And for every month we use, we are going to put $10,000 to the insurance expense account. So we would debit insurance expense and credit prepaid, right? So that's the monthly entry that needs to be done. In reality, if we step back here for a second, in reality, when you enter this prepaid, and this is the way that I had my staff do it for me when I was still in industry, what I would have them do is I would have them enter this prepaid amount, right, $120,000 into prepaid insurance, and then when they went at month end to post this adjusting entry, right, here's our adjusting entry, when they went to post this adjusting entry, I would have them set it up as a recurring entry. In financial statement software, and you guys will probably get some exposure to this when you look at things like ACPAC or QuickBooks or Simply Accounting, they have an option that allows you to set an entry as recurring. You can say how many times you want it to happen. So what I would have my staff do is I would have them set up this entry right here in our books, right? Go into the system and debit insurance expense and credit prepaid, and then I would have them have it after posting that, they could set it to recur 11 more times at the end of each month. So you can set the frequency and you can set the timing, and so each month they wouldn't have to worry about entering this insurance expense. It would just automatically populate to the income statement. Okay? So that's the standard method, and if you wanted, you could go back here. We looked at prepaying something. This could also be someone prepaying us. So having unearned revenue, right? If someone were to prepay us and we were the insurance company, we would debit cash because they paid us, and we would credit unearned revenue because we haven't provided them with the insurance services. So that's how we would set up the initial entry here. Then the monthly entry for us, if we were the insurance company, right, would be to debit the unearned revenue because we've now earned some of it, and to credit insurance revenue or sales revenue or whatever they would call it, right? But again, the initial entry goes to the balance sheet and the adjusting entry goes to the income statement. And that's the whole premise behind the standard method, right? So if you didn't understand anything, or maybe it went a little bit too quick, you can always replay this video. And again, I would recommend now going to the textbook and trying to find some questions that are practicing the standard method, and I would see if you can apply that methodology. Okay?